If you want to know where the markets are going in the next 90 days, you don't need a crystal ball. You need three numbers. You need the Fed interest rate decision, you need the unemployment numbers, and you need earning revision numbers. Now, why should you listen to me, and how do I know this?
I was mentored by the Institute of Trading and Portfolio Management ex Goldman Sachs traders Anton Creel and Edward Scheck, and the portfolio manager of Dragonstone Capital, based out of Singapore, managing $3 billion. In addition to that, I have completed multiple specializations and have also created my own algorithm which is running in the markets, which has generated me over a 7,500% return over the last 15 years, all of which you can find in the bio.
The first indicator is the Fed interest rate decision. The market doesn't rally because companies are great. The market rallies because money is cheap and companies can now borrow more. Companies have a lot of debt. Now, the debt can either be rolled over or it can be paid off. If interest rates are high, then companies basically owe more money on that debt, and that's not usually a good thing. But in this case, because we are getting a lower interest rate, that's going to basically reduce the debt burden on companies. A lower interest rate is extremely bullish for high debt and high growth companies, especially now the theme is tech. A lot of tech companies have a lot of debt. I would consider being long those kind of companies. Here's a statistic for you. Since the 80s, after a first Fed rate cut, the equities are usually up double digit percentage wise in the next 12 months that follow. Well, there you go. That's your sign. Earnings revisions. Now, a lot of people don't really understand what earnings revisions are. People just see whether a company beats earnings or misses earnings. That's not what pros do. Pros basically look at the forward guidance of the companies, which is usually something you can find when they issue or something you can see in their earnings transcript, where the CEO and the chief financial officer would basically give an outline of where they think the company is going to be in the next quarter, by the next quarter, and the next 12 months. They will give that kind of guidance, and that's what pros are using. That's what pros are looking for. You have analysts consistently revising and upgrading their stocks, their stock targets, downgrading those. Stocks move huge based on like analyst targets and analyst upgrades or downgrades. That is also something which professional traders look for in great detail and look online. You can find this information on Yahoo Finance or Markets Watch or Markets Beat. So we've got the Fed interest rate decision and we've got earnings revision and analyst upgrades and downgrades. What's the third one? Now, the Fed determines its interest rate not just based on what inflation and the core CPI numbers are. The Fed basically determines the Fed interest rate decision based on unemployment too. Right now, unemployment is running at 4.2, 4.3%, which is kind of high. And even though we are running at like a 3.1, 3.2 CPI number right now, inflation is going to increase a lot after we get this Fed cut. But because unemployment is so high and is the job numbers came in a little soft, we can expect a Fed rate cut, and it's already priced in the markets this September. Now it is 25 basis points, but maybe we might get even get 50. I don't know. Let's see what happens. But to summarize, those are the three numbers which you need to look at, and these three numbers tell you where the market is going in the next 90 days.